Let's be honest, seeing your investments dip can be unnerving. It makes you question your choices and can make you want to just hide your money under the mattress. But giving in to that fear can actually hurt your long-term growth. The real power comes from having a clear, understandable strategy that keeps you in the game, calmly and confidently, through all market conditions. Welcome back to the channel. Want to build an investment portfolio that you feel genuinely good about, even when the market throws a wobbly? It's not very complicated. It's about having a solid game plan beforehand. In this video, I'm sharing 5 easy steps to build a killer investment portfolio so you can stop stressing about the market's daily moves and start focusing on your financial future. We'll cover everything from figuring out your financial goals and how to match them with the right investments, to spreading your money around smart, structuring your portfolio effectively, picking investments wisely beyond just past performance, and having a plan for when to buy and sell. Ready to build with confidence? Let's go! Before you even think about investing anything, you gotta ask yourself, what are you saving this money for? Are you trying to buy a new car in a couple of years? Planning for a down payment on a house in 5? Or are we talking long haul, like retirement decades from now? Perhaps you're saving for your kids' education or even just a future splurge like that dream vacation. Pinpointing exactly what you're investing for is the crucial first step. Knowing your goal is like having a map. Once you know your goals, you can start matching them with the right investment strategy. Generally, we can think of a few main approaches. For long-term goals like retirement or education that's still a ways off, you'll likely lean towards a growth strategy, aiming for higher potential returns over time, even if it means taking on more risk. For shorter-term needs, like your emergency fund or education expenses coming up soon, preservation is key. You want to keep that money safe and easily accessible, so you'll likely focus on lower-risk options. Now, let's talk about your comfort level, your risk tolerance. How do you feel about the possibility of your investments going up and down? Are you someone who stresses easily when you see a dip in the market? Or are you okay with some bigger swings for the chance of potentially higher rewards? Maybe you're somewhere in the middle. It's super important to align your risk tolerance with your goals and chosen strategy. If you have a long-term growth goal but a super low-risk tolerance, you might not see the returns you need. Conversely, taking on too much risk with money you need soon can be nerve-wracking and potentially derail your plans. Finally, to make all this actionable, let's set up a simple investment workflow. First, write down all your financial goals clearly and give them a realistic timeline. When do you hope to achieve each one? Next, for each goal, assign the appropriate investment strategy, preservation, cash flow, growth, and consider your risk tolerance. Then, make it a habit to review your progress regularly. Are you on track? Do your goals or circumstances need to be adjusted? And lastly, based on your goals and timelines, figure out how much you need to save and invest annually to make those dreams a reality. There are tons of online calculators that can help you with this. Now that we've got our why sorted, let's move on to step 2, and it's a super important one. Step 2 is about asset allocation. Now, this sounds a bit jargony, but it just means mixing up your investments. Think of it like a pizza. You don't want just crust, right? You need sauce, cheese, toppings. Different things perform differently. When stocks are having a tough time, maybe bonds are doing okay. When one part of the world economy is wobbly, another might be booming. Asset allocation just means deciding how to split your investment money across different types of assets. We're talking things like stocks, bonds, safe assets like FDs, then gold, real estate, good old-fashioned cash, and maybe even some crypto, if that fits your profile. The mix you choose isn't random. It should be built based on what we talked about in step 1, your goals, how soon you need the money, and your risk appetite. Avoid the extremes. Now, while it might be tempting to go all in on the hottest thing you hear about, try to avoid extreme allocations. Putting 100% of your money in just one thing, like only stocks or only bonds, can be super risky. If that one asset class takes a nosedive, your whole portfolio is going to feel it big time. The goal here isn't just to get the highest possible returns no matter what. A smarter way to think is about improving your risk-adjusted returns. This means trying to get the best possible return for the amount of risk you're comfortable taking. By spreading your money around, you can potentially lower the overall risk of your portfolio without necessarily giving up all the potential for growth. It's about finding a balance that works for you. Your asset allocation can be percentage-based, like 50% in growth-oriented assets, like stocks, and 50% in safe assets, like bonds or FDs. Alternatively, you can have a safety cushion approach. Figure out how much money you need to have readily available or in very stable assets to feel secure. Maybe it's enough to cover 3 to 5 years' worth of expenses, or a specific amount for a short to mid-term goal. This is your safety cushion. The rest of your investment money, the part you don't need in the immediate future, can then be invested in growth-oriented assets based on your time horizon and risk tolerance. So, step 2 is all about building that diversified mix. It's your personal recipe for balancing risk and potential reward. Now that we know what kind of ingredients we're using, let's think about how we're going to put them together in step 3. How do you actually structure that mix? Do you find this helpful? Share the knowledge with family, friends, and colleagues. And don't forget to like and subscribe for more such useful information. A really popular and smart way to structure your investments is using the core and satellite approach. Imagine your portfolio is like a solar system. The core is your sun. It's the big, stable center of your investment universe. This is where you put the largest chunk of your money, usually into investments that are broad, diversified, and generally lower cost. Think things like broad-based ETFs or mutual funds that track major market indexes, like the overall stock market or a big bond index. The goal of your core is to provide steady, long-term growth and stability to your portfolio. It's your foundation, your anchor. Now, orbiting your core, you have your satellites. These are smaller, more targeted investments. This is where you can add some potentially higher risk, higher reward plays. Maybe you're really optimistic about the future of technology, so you invest in a sectoral fund focused on tech. Or perhaps you believe in a specific trend, so you invest in a thematic fund related to, say, renewable energy. You might also use satellites for more tactical moves, like investing in pre-IPO stocks. A common way people use this approach is with something like an 80-20 core/satellite split. This means roughly 80% of your investment money goes into your stable, diversified core, and the remaining 20% is allocated to your potentially higher growth satellite investments. Of course, this split isn't a strict rule and can be adjusted based on your individual risk tolerance and goals. Maybe you're more comfortable with 70/30ths or even 90/10ths. Now that we've got our portfolio structured, how do we actually pick the specific investments that go into it? That's next in step 4. Now, this is where a lot of people get stuck. It's super easy to just look at what went up a lot last year and pile into that. But picking investments based solely on past returns is usually not the best long-term strategy. What did well before might not do well in the future. Instead, it's helpful to have a more structured approach to make sure you're getting proper diversification within your satellite or even parts of your core holdings. Here's one way to think about it, especially for equity-focused investments. Imagine a 3x3 grid. On one side, you can think about the size of the companies you're investing in. Like large cap, these are the big, well-established companies you know. Mid cap, companies that are still growing but are past the small startup phase. Small cap, younger, smaller companies with higher growth potential but also higher risk. Across the top, you can think about the style of investing. Growth, focusing on companies expected to grow their earnings faster than the market. Value, looking for companies that seem undervalued by the market. Momentum, investing in assets that have shown recent strong price trends. This grid helps you visualize different pockets of the market. The easiest way for most people to fill out a grid like this and get instant diversification within each segment is by using ETFs or mutual funds. There are funds specifically designed to track large-cap growth stocks, small-cap value stocks, and so on. Here's some examples. These are for reference. You can do your research and choose one of your choice. By picking a few carefully selected ETFs or funds, you can quickly build a diversified portfolio across different sizes and styles of companies. This brings clarity to what you own and helps you avoid being overly concentrated in just one area. This 3x3 grid is just a starting point. You can totally adapt the grid as you become more comfortable or as your strategy evolves. Maybe you want to add a row for microcap stocks. These are smaller than small-cap companies. Or include columns for international investments or different investment styles like quality or low volatility. The idea is to have a framework that makes sense to you and helps you build a well-rounded portfolio beyond just chasing what's been hot. Now that we've picked our investments, how do we know when it's the right time to buy or sell? That's what we'll talk about in Step 5. All right, Step 5 is about entry and exit strategy. This isn't about trying to time the market perfectly, which is super hard even for the pros. Again, it's about having a plan. For entering, you might decide to invest a set amount regularly, no matter what the market is doing. We also know this as rupee cost averaging, and it can help smooth out the bumps. It takes the guesswork out of when to invest. You just stick to your schedule. Now, what about getting out? This is just as important. One key part of an exit strategy is often tied back to your goals from Step 1. Booking profits when goals are met. If your target is met, move it from growth-oriented asset to stable assets, e.g., you have a goal to save X lakhs in 15 years. If you achieve the goal in 13 years, book your profits and park that money in a safe asset like a government bond or a fixed deposit. This locks in your gains for that specific goal and ensures the money is safe and available when you need it, without being subject to market swings in those final couple of years. You could also have other exit triggers. Maybe you set a target profit percentage for a satellite investment. If it goes up by 20%, you sell half. Or you might use a stop-loss idea, deciding that if an investment drops by a certain percentage from your purchase price, you'll sell to limit potential losses. Another scenario, having met your key financial goals, if your objective is now purely wealth growth, managing your portfolio largely involves disciplined rebalancing to keep your asset allocation aligned with your strategy. Whatever your entry and exit rules are, the most important thing is to write them down and stick to them. This is where having a plan really helps you stay disciplined and takes emotion out of the driver's seat during those inevitable market ups and downs. So there you have it. 5 key steps to building your investment portfolio. Know your goals, diversify your assets, structure smartly with core and satellite, pick investments wisely, not just on past wins, and have an entry and exit plan. Remember, investing is personal. Your perfect asset allocation might look totally different from mine, and that's perfectly okay. It all comes back to your goals, your timeline, and what helps you sleep at night. Start small, keep learning, and adjust as your life and goals change. You got this. See you in the next video.